I'm joined by Charles Evans. We're going to put it to him, actually, whether he likes his moniker of being called one of the most dovish members of the FOMC. Charles, welcome. Thank you very much indeed for joining us. And how do you like that?
Oh, that's perfectly fine.
OK. Well, the thing I want to get to is everybody's been fixated by this inversion taking place in the yield curve. Tell us about your view of this and what it perhaps portends.
Well, I mean, it's certainly the case that the yield curve is flat right now. Long-term interest rates have come down over a very long period of time, and so it's not surprising that yield curves tend to be flatter. But there's, a bit more of that now. Yeah, I tend to first thing I look at is the 2 to 10 year, and when I looked on Friday, it was 14 basis points, and so it's really quite flat. The yield curve is something that people are always asking about, looking at. Is it a recession indicator? It's always difficult to find a nice leading indicator. Many are contemporaneous. It's difficult to find leading. If you put yield curves, last time I looked last week, into a statistical model, they were throwing off a slightly higher probability of a recession, but nothing, really different than an unconditional forecast. They've often misfired in terms of forecasting recessions, but it's certainly something to be paying attention to, and we're looking at monitoring the data. I mean, after all, the FOMC just announced that we're pausing, we're going to look at the data, we're monitoring all of this, and so financial conditions are clearly something that we're looking at.
Are you looking at perhaps leading data, and you use the word contemporaneous? Is it contemporaneous with the way that the FOMC is thinking right now? That's the point.
The yield curve?
Yes.
It's like, at the moment we've seen slower data, the consumer retail sales a little bit. The first quarter is looking like it's going to be weaker, but the current expectation is that it's going to be temporary, that we should bounce back somewhat in the second quarter. And I'm looking for growth this year, 2019, to be 1 3/4 to 2%. That's lower than 3.1% like we got last year, but it's it's either at or a little bit above trend growth. So that's actually a good year, but it's decelerating from 3.1%. And one of the things that always gets everybody's attention is it's lower than 3.1%. So that doesn't feel quite so good, but it is a pretty good number.
I'm going to be one of those people and ask you the question, why is it?
Well, if trend growth is 1 3/4%, you don't get above trend all that often, especially once you get to a mature expansion. We've just this year we're going to be coming to the end of the fiscal stimulus that took place after the corporate tax reform, the tax cuts, and the government spending increase, and so that's waning. They added perhaps half a point to 2017 and 2018, but that's going to be spent, so it's pretty much back to trend growth. Labor market's very strong. Unemployment rate is low, and that supports a strong consumer, so we should be able to continue with that type of trend growth, I think.
Okay, so tell me what happened then between December and January and February, where we had only 2 people on the FOMC at that stage thinking the rates are okay where they were, and now 11 think they're okay where they are.
Well, the 2 people in December presumably didn't want to increase the funds rate the way we did, the 25 basis points. So I agreed to the December rate increase. I think that took us up to just about the right level. We're targeting 2 1/4 to 2.5%. That's a little on the low end of where we think the neutral funds rate is. And so monetary policy by this judgment is neither adding to the expansion or holding back. It's at almost a neutral level. I think that's a good place to stop and look. Now, clearly the markets were flummoxed by the commentary about the balance sheet. The balance sheet, has been continuing to roll off down towards $3.5 trillion, $3.6 trillion. We just announced
this is SOMA, is it?
SOMA, the System Open Market Account. That's right. And so we just announced that we're going to end the redemptions of maturing assets in September. We're going to taper beginning in May, and by September we think that the SOMA balance sheet will be about $3.6 trillion. We expect to hold the balance sheet in that range for a period of time. We think that with the economy growing, non-reserve liabilities will increase so that reserves will continue to go down a little bit, but we'll be running a floor system in order to support our funds rate target range, and so that'll be an important part of our policy.
Being data dependent as you are, yes. You're looking at the data in December, you're looking at it in January. What materially changed for you?
Well, we had more restrictive financial conditions at the end of last year. and strong growth. Then you get into the first part of this year, and then markets rebounded after, we communicated a little more carefully that we think that the policy is in a good place and we can monitor and pause for a time. But the economy ended up slowing down a little bit with the first quarter. Now we're trying to figure out how this plays out. So financial conditions still seem to be quite reasonable. And is the first quarter going to be a temporary slowdown, or is it going to be something more than that? I'm optimistic. I think that we're going to finish the year 1 3/4, 2%. I think that's pretty good. However, I'm a little nervous about inflation. I think inflation is close to 2%. That's good, but I'm worried that it still takes accommodation to keep inflation at that level. And so I actually marked down my path for policy rate increases so that I basically got policy on hold until the fall of 2020 so that we can see how the economy is playing out, add just a little bit of additional accommodation or not impart any restrictiveness in order to further support inflation rising above 2%. I've got inflation rising to 2.2% by the end of 2021. I think that's consistent with the symmetric inflation objective and helps solidify the idea and belief that we're going to get inflation to our target, we're going to make sure we get it there, and we're going to have as much capacity to cut rates in the time than we really need it if things slow down. But at the moment, things look good.
That's why you're patient and you're pausing.
That's right.
Okay, now the other thing is we look at the statement last night, and if I recall correctly, you talked about employment, and you called it at that stage as last time it was strong. In the latest minutes, it's solid. Why the change of that word? Is it a downgrade? Or am I being pernickety?
Well, strong is stronger than solid. You're exactly right. The February employment number came out at 20,000. 20,000's low.
It was a build out of the blue.
We think it's a bit of an aberration, perhaps. And if you average it in with the previous month, which was very strong, the 2-month average comes to 165,000. Now, 165,000 per month is still a good amount. We've got a very mature expansion. We expect that sustainable employment growth, that when you're just at a completely mature expansion, is closer to 100,000. So 165 is still consistent with growth above trend. But the most recent number was 20. We want to look and make sure that the labor market continues to improve and how that's going to play out from here.
Charles, if you got another repeat of February, how would you look at it?
Oh, well, if we got another 20,000, I think we'd probably, have to think that there might be a little bit more signal. I think we'd have to be paying attention to what labor force participation is doing, what wages are doing, the entire picture. I would say that, when you see downturns, they're usually negative employment reports, so another 20 might, but, 20 would be a low number. We'd obviously be paying attention to that.
Tell me, how much is, we haven't got that much time, is the trade war playing out in this?
I think it adds to the uncertainty that businesses have to think about in pursuing future plans. I think that there are a lot of businesses that are in a good position to continue their expansion, to continue to take advantage of new technologies, the disruption, to adjust their plans in order to continue going forward. But as soon as you have to also worry about the international environment in a way that you didn't have to, if you're a larger corporation that has arranged your supply chain, that crosses borders, that worked very well for a long period of time, and now you have to wonder if that's going to continue to be an important part, or if you have to adjust it or dismantle it, that would be very costly and time consuming. So that uncertainty is something that businesses have to be grappling with. It can't be a positive at the moment.
What about China? That slowdown? How does that impact your thinking?
So I think that's more uncertainty. I think with China, there's reason to believe the session that I attended just this morning, the suggestion was that the Chinese government is looking at continuing the growth prospects, whether that's explicit stimulus or just sort of right-sizing some things that they've been doing. I talked to some business people who have operations in China, and they're modestly hopeful that things will smooth out. I think that the foreign growth outlook has definitely slowed compared to 2017. 2017 was very strong. That was an important component in U.S. growth and world growth, and now they've stepped down. Europe has stepped down. Brexit is an uncertainty as to how that plays out. There's just a lot of things up in the air. And the more uncertainty is resolved so that businesses can go about doing what they do best, which is planning for the future and adjusting to the risks, that would be beneficial.
Charles, just France and Germany, the PMIs lately have been well, really painting a poor picture. The global economy is not doing well. If it gets worse, America is not an island ultimately. How does it get affected? And how does it affect your way of looking at monetary policy?
You know, as I say, the more foreign growth slows, that has negative ramifications for everybody. It would have some implications for the U.S. I don't think that it would be a showstopper or anything like that by itself, unless it was amplified by other factors. I think that Brexit is a wild card. You know, it's unclear, although it continues to be extended, it seems, or that seems like the hope. So I can't guess exactly how that'll play out. The, you know, whether it's Europe relying on, you know, China a bit and them being slower, or it's just the configuration of European countries that all of them together are a little bit weaker. Germany obviously had emissions standards, which affected auto production to some extent. So there are a variety of factors, and this is one of those we're going to have to monitor and be patient and look at the data.
Charles, yes or no, was the December hike a mistake?
No, I'm very comfortable with where we are.